Let's shift focus and talk about markets. Nimesh Chandan of Canara, Robeco, AMC is here with me. Nimesh, you are listening to your friend from the investment banking side. And pretty much historically, your fund, the strategies which you adopt have been tilted in favor of quality. Bajaj Finance falling into that category as well. I don't want a reaction on that particular stock, but that basket, where do you stand now on that basket? Are you also deploying incremental flows there? Or on the valuation front, you are now willing to dip your feet more toward the broader market as well?
So in the past 1.5 or almost 2 years, quality and visibility combined as a theme has done extremely well. While people say it's only quality premium that is going up, I would say quality companies which are in cyclical sectors have not really seen that kind of flows attracted in those stocks. We as a house have always been tilted on quality. 2 years back, we shifted more weight towards companies that we see good visibility in or more certainty, and we have benefited through that trade in the last 2 years. At this point of time, we are seeing signals or green shoots where on one side, the international environment is turning towards more positive or bottoming out. On the other side, we see in many of the cyclical companies, especially in the mid-cap and the small-cap segment, the prices are already factoring in or discounting the slowdown that is there.
Sure.
In fact, the narrative, I think, domestically will change where we had a good festive season. People will wait for all the efforts that the government has taken in the last 2 months to start showing results. Maybe the first leg we will see maybe in metal stocks or international cyclicals, where we will see upturn in these companies' profits.
Right. In fact, I'll get your view on another development which has happened today. We were speaking to Chief Economist of SBI, Shaumikanti Ghosh, and he has come out with a note saying that don't be surprised if the second quarter economic reading, GDP reading could be sub 4.5%. Let's get a slice of that commentary, and then we'll talk about where do we lie right now on GDP growth estimate versus market cycle.
See, all indicators are showing a slowdown, has shown a slowdown in the July to September quarter. If you look into the acceleration rate of the 33 leading indicators which we track and which has a close correlation with the GDP growth rate, the monthly acceleration rate is now down to 17% in September. So that is at an historical low, and that has been declining more from around 65% just a couple of years back to around 17% right now. So the deceleration has been significant, and it has gained pace from March 2019. So while there could be always some plus minus 10-20 basis point impact on the estimates, but it's certain that the GDP growth rate this quarter will be sub 5% and possibly sub 4.5%.
Nimesh, you heard the commentary of the economist, and I wanted to explain to our viewers where do we lie right now in terms of economic readings, which may be looking very terrible, but how they may not be capturing the lot of steps from the government side which have been taken, and how global macros have changed, and why market is not reacting too much into it, and where do we lie on the market cycle versus macro cycle?
So, so interesting talk there. I'll just give a perspective over a slightly longer cycle that we are experiencing. The slowdown today that we see is a result of all the events that have happened in the past 6 years. We saw most of the macro parameters peaking at somewhere around 2012 or 2013. The excesses that were created in the previous cycle, they took some time to actually get erased. You had a tight monetary policy. After August 13 experience, the monetary policy in India has been quite tight in terms of interest rates as well as in liquidity terms. We had a tight fiscal policy. We had a fiscal deficit of 6%. We brought it down to 3%. And during this period, we also went through a banking cleanup where NPAs, historical NPAs, were written off in a very short period of time. The impact of these changes, and also GST, demonetization, implementation of RERA, all these changes impacted largely the informal sector. In the formal sector, the corporates, instead of looking at adding more capacity when they already are at low capacity utilization and they don't see demand visibility because of the changes, they would rather look at deleveraging rather than doing more capex for the future. Government has also kept its purse strings tight during this time. I think all these factors affected growth. We had to sacrifice growth for that. But all these factors are now changing towards the positive. We are probably in that interim phase. Now the monetary policy is on the easing side. Government has taken in the last 2 months steps which will start probably showing results by April or May, where we have a better fiscal policy now. The implementation of GST, RERA, demonetization, the effects have now waned. So actually the business cycle is now ripe for an upturn. It's just that you can't really pinpoint this is the month it will start.
Sure.
Possibly this festive season and this quarter may start seeing some improvement already.
I would also like to get your views on your interactions with the mid-tier managements. We had Indian hotel managements on our channel, India Cements management on our channel. In fact, let's get a slice of those two managements, and then I'll get from you your interactions on what feedback you're gathering from the mid-tier segments of the market. Let's hear out Indian Hotels and India Cements.
The impact of slowdown for the industry in general and for us has been there. So same time last year, we would have thought we will do possible double-digit growth. So we had to come back to kind of single-digit. However, we have been able to, and that's the job of the management, to maneuver through these headwinds and put strategies into place so that we have no impact on our earnings. We have been adding hotels and our ambition is to add a hotel per month. And all these hotels are on a fee-based model or without investments from us. If the more service-based contract that we add, the more management contracts we add, the more operating leases we add, will add to our margin expansion because mathematically it works that way. And as we have communicated to the market, we'll add 15 hotels to our pipeline. We had a higher share than the RevPAR growth in the market. So that's been positive. Despite all the discussion on Brexit, I would say have been the best in the last 7-8 years for us in that market. Our hotel in Cape Town is improving by leaps and bounds every day. So I think we are very blessed to be in some of these fine locations. We are opening 2 more hotels in Dubai in the next 12 months, one opening next month in Jumeirah Lake Tower, and the third one just before the Expo comes to Dubai on the Palm. And then there is a fourth one also that will be Dubai Dera waterfront, which will take another few years. But we have 4 Taj properties in Dubai.
I would say that in the southern region, it is the change of guard in Andhra and the fact that that has impacted the infrastructure demand and the government demand. For example, the entire Polavaram dam that has been delayed, but it will come back. See, one has to recognize that these are not permanent stops. It is temporary, and I personally think by the for the next quarter, we should see demand back. I think at the moment, firm prices will prevail because demand also slowly picking up. See, last year, take our own company, India Cement. We have worked at 83% capacity utilization. This second quarter alone, we went down to 68%. I suspect that I will go well past 70% in the ensuing quarter, the next 2 quarters.
Right. So talk to us about the research which you have conducted in the broader markets and what are the key takeaways in terms of how attractive that pocket is valuation-wise?
So, as I said, we are taking a stand that the narrative has now changed for the international markets and will start showing changes in the Indian domestic economy also. So, for the last 2 years, globally and even in India, money has moved towards large cap, low beta, more visibility stocks, defensive stocks. And on the other side, people have been selling high beta, small caps, mid caps, so on, or cyclicals also. We did a study for the small cap, the companies which are below 10,000 crores of market capitalization. And we did an average ROC for last 3 years. We found that there are at least 100 companies in small cap space which have ROCE of more than 16% average in the last 3 years. And within this basket of companies, there are a lot of companies which are actually having cash-rich balance sheets instead of having debt, have historically had a good growth rate. Say if you take their 5-year or 10-year growth rate in their sales and profits. It's just that they are going through some cyclical downturn because they are more connected to the economy today. These are the times when you can pick these companies which have good corporate governance, good balance sheets, have demonstrated leadership in a particular segment, either by brand or market leadership, have good ROCs, so the business models are good. So good management, good ROCs, and you are getting them. So valuation is debatable here because some of them are at a cyclical low earnings.
Sure.
So you can't give them low valuation on a cyclically low earnings itself. So I think that space becomes very interesting, and possibly this is the space which will give better returns to investors than just the large caps.
Right. All right, Nimesh, thanks very much for dropping by to our offices. That was Canara Robeco view coming in on the markets and the valuations.